Okay, guys, let's have a great week, everybody. Hi, Patrick, KT. Everyone ready? So I just wanted to show Blake that I have the new headset Steve picked out for me. This is Major Tom to ground control. All right, so it's my new rig, everybody. Let's have an excellent week. So starting off with the dollar. We will diverge on the 1 hour time frame at new highs, and we didn't quite get to that 92 line the other day, and I don't believe that we'll get confirmation up here. My best guess is we're having follow-through strength because we had a good week, right? Great week in the dollar, this candle here, and normally follow through on Monday. With you guys have heard it from me a million times, possible turnaround Tuesday. So I want to see what happens at new highs in the Dixie. The yen never quite got to the line I had. So, you know, it's basically the same thing happening here. Yen actually has a little bit weaker picture because on Friday, and one of my mentees pointed out to me, we had a 4 hour non-confirmation here, but it looks like we should get a third drive. Maybe we're not even going to make it up to this trend line that's up around 110, 109.80. But I think there's going to be a breather in the dollar this week. I'm curious. So this is how I start my week. And let's pretend I haven't even looked at TL, the traffic light page. So, you know, those are a few of my ideas. I could just go to any of the pairs I just talked about and get all kinds of different views. And I'm curious what's going on. Okay, the guys are short Euro Yen, that's working out for Blake. Stelios still long Aussie Kiwi, that's up again today. I still think there'll be a better place to buy it if you're flat. And Andre's got that harmonic going in Aussie. We're still getting follow through to the downside in gold. So that's with yen strength. We're not that far away from a breakdown, something that I've mentioned for a month now in the gold. So I think there could be some trades. Guys, we don't have the Fed this week, too, on top of NFP, do we? It's just NFP on Friday, right?
We have the Fed actually on Wednesday. We have the FOMC, and then we do have NFP.
Isn't it kind of unusual that the Fed meeting comes before an employment number like this? Usually they have some, you know, an employment number to, you know, make a decision on. But yeah, it's really a red week then, Blake.
Yeah,
a lot of red events.
Very, very busy week. Yes.
Okay. So I'm going to turn it over to you in a minute. I just want to show everyone. Yeah. You're probably getting ready anyway. So gold, still not doing anything right. It's been my contention. We have to clean out the stops here. Maybe 61.8 is going to hold. I see two scenarios. Okay, a lot of people are going to call 1300 a breakdown. And if you just do a measured move from 1300, gives you 1240. Okay, the other scenario is we just have a stop hunt and shake out the 1300 bulls. And how you know that will be happening is when, if we take this out in gold, we start closing back above the breakdown. So, and there'll be some cues from RSI on shorter term TFs. So I'm watching this. I still also in silver, I'd like to see Steve's triangle today. I'm wondering where the triangle breakdown is going to be on that huge symmetrical triangle that you have, Steve, on silver. You know, sometimes in these big formations, the first breakout is a fake out, and I'm be interested in seeing what your silver looks like. Risk looks on, guys. So I don't see anything to do off the bat. I wouldn't get short metals here now after the big break we had last week. And the gold silver ratio, despite this decline, is not making new highs. So that's going to be an interesting test to see how silver holds up if gold takes out 1,300. I think there's a chance for at least these lows to be tested. And someone that I really respect is saying 1570 and then 1880. I just don't see anything at 1570 besides previous lows. I kind of like the look of this baseline on silver, which projects a whole lot lower. I would think this might be if the dollar rallies to 94, 95, maybe silver could get down there. And even crude is feeling the effects of a strong dollar today. But I think there will be at least a corrective trade. You know, it's a good way to approach it is, you know, I know Steve and Blake, they've been working the short side of euro yen, so they have, you know, both. If the euro reasserts its downtrend, which it is right now, but not making a new low, I almost favor that we're going to put in a higher low today or tomorrow and not take this out and get some type of rally back towards 2180, 22, and then we'll see. But either way, I think that there's a potential scalp, short-term scalp. The question is, do we make a new low first? My bet is that we don't, and that, you know, if you're a bear, this would be A, B, C to get short for another wave down. And that's the way things look to me. You know, I've discovered over the years that, you know, not to make big calls on Monday, because I do see Monday most of the time as a follow-through day. A lot of people still have last week's history on their mind. So, you know, let them have another day to continue to work the trend. And then I'd be looking for some reversals tomorrow. Hi, Nitish. You like my headset? I've never used one before. So I kind of like it. Maybe I did in my dormitory in college when I was listening to Led Zeppelin. Yeah, it's been that long. All right, well, I'm going to turn it over to Blake. Let me just tell you guys, I think we have the strongest week of interviews that I've had, or we've had, since the beginning of phase. So today I have Stephen Aniston, who's very well known for his work with VIX. I think his nickname is Stevie VIX. And then Jonathan Chevreau, you guys probably know him from Twitter. He's an economist. And then we have Mark Yusko, who's very well known, super bull in crypto, and he's on CNBC all the time. And then I've been working to get this interview for a few years, and we have Jim Rickards, author of Currency Wars, with us on Thursday. So don't miss that. You know, Jim comes up with some very esoteric narratives. So I'm going to ask them both market-related questions. Yeah, Stevie VIX. That's what his Twitter says, Joe. Thank you, Michael. And so let's have a great week together of edifying each other, supporting each other in the private chat, where there's much more interaction than there is in our free webinar. Members can communicate with themselves. So, you know, don't assume that the private chat for members is just like the chat is here, because you guys can only post questions. In the private chat, there's interaction between the members, okay? So that means when you're in there, we have trust, and that, you know, for the most part, there's very good decorum in there of people supporting each other and sharing ideas. So it's a little different spin on it. It's wide open in the private chat. You need to check it out. So how was your weekend, Blake?
Good, Dale. Just it was a hot one. It was a scorcher here this weekend. It's so funny because, you know, I'm chatting with Amanda and obviously the rest of the people in the chat room as well, and they're there in the UK, and they're talking about how cold it is, and I'm like, man, my kids were swimming in the pool yesterday. I've got tan lines from my flip-flops. It's hot here. You know,
yeah, early start.
It is, but I mean, it's supposed to cool off later this week for us.
Yeah.
You know, But
we're supposed to get some rain, so you'll get it after us.
Yeah, I think we're getting the we're gonna get the I don't know
monsoons?
if we're gonna get rain. No, monsoons aren't for a few months, but oops, dang it, that's not what I want to do. I forgot that it changed
you
my
get those
screens.
big haboobs or whatever they're called.
Yeah, right. No, it's supposed to cool down, and we'll get some clouds, or we get like the tail end of your whatever storms that you guys get over there.
Oh, but, and thank you for the headset. I haven't heard anyone complain that they can't hear me this morning.
I was gonna say your headset sounds phenomenal. We're glad that you're liking it, and I mean, you sound awesome. So, and it looks good on you.
Cool.
Yeah, you definitely look like you're back in the dorm room with this big cushiony headsets. I remember my dad had.
Oh, here we go. Yeah.
On the reel-to-reel.
Yeah, I'm probably closer to your dad's age than yours. Maybe I'm like an uncle. I'm your rich uncle, Blake.
You're my rich uncle. There we go. So it's been I sold a little bit of euro dollar last night at the 50 level here at 121.30, but I thought we were going a little higher. So unfortunately, I didn't get too aggressive last night. I have orders to be aggressively short, but they just didn't get tripped. I got up this morning and I'm like, I saw messages from my broker because I trade through JP Morgan. And so I saw messages that it came within 20 pips of my orders, but I was like, did they trigger? And then I pulled up everything this morning, and obviously I didn't get into the position. So
maybe you will tomorrow if you leave them in and we hold the high or low and it rallies into, people start to think about short covering into the Fed.
Well, yeah. Well, there's a couple things. First of all, it is month end. Don't forget it's month end today. So today's the last day of the month. We might get some volatility. I personally, I agree with you, Dale. I actually don't think that we're going to hit new lows here, but that's more of a hopeful rather than I'm looking at everything thinking that it's more hopeful than anything. However, I wouldn't be surprised either if we do this, and this is the euro dollar. This is a 4-hour chart, so I'm gonna I'll draw it out for you. I wouldn't be surprised if we do something like this for the next couple of days. So will we hit will we come up here and get new highs? I don't know. The dollar is strong, man. The dollar is very, very strong. I did, and this is total counter trend. So just understand that this is extremely counter trend. I actually bought some cable this morning, and I know some of you are like, why would you buy the cable? If you have ForexAnalytix, I sent out this chart, okay, right here, and you can see we are at horizontal support, 161% extension, divergent relative strength. The trend line from the bottom, from the lows of the cable, it comes in right here, right there, and we're there. Now, I do think we eventually break. I think that the cable breaks through 137, and then we have this double top and false breakout over here, and we head down to like maybe 132, maybe 133. I think that happens. I don't know if it's going to happen today. I doubt it's going to happen today. I think we have to get a running start. It's like imagine a battering ram going into a wall in a castle door or a castle gate, a battering ram. Usually on the first try, it's not going to make it through. The first try it weakens the gate, and then everybody, you pull back, and then you make a running start at it. So if I had to imagine, it's going to look something like this: boom, 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 like that. If I had to guess, okay. Now, with that being said, I actually bought a little cable only 10 pips away from here. So and I'm not risking much, because if we break through 137, this thing's going a lot lower faster. Now, a couple other things. You know, you take a look at the Aussie. Let's take a look at the Aussie dollar. Here's the Aussie. You know, we're back down at the 161% extension. The Kiwi, near the 618, near the trend lows. Dollar Canadian, we're having a hard time getting back up to the 129 level, which is the big 618. Swissy's actually is so damn bullish. It's amazing, but we're almost near our highs, but we haven't hit new highs yet. This is inverse of the euro, so it's just going to do whatever the euro is doing in reverse. You know, the US dollar Swedish krona, it's stalling well ahead of the spike highs from last week. US dollar Norwegian krona, it's stalling ahead of the spike highs too. So will the dollar continue higher? Oh, and I guess we should talk about the dollar yen. The dollar yen's kind of stalling as well. We could, but you know, I think you got to be a little careful with the dollar down here. I'm like I said, I bought some pound. I'm not married to it by any stretch of the means. I just know what major support it is. In my opinion, it's the bull bear line for the cable. You know, so if you look at the pound, bull bear line right here is 137. Okay, I think we're there right now. You know, if we drop below 137, then it's, you know, it's game over for the cable. But I don't know if it's going to do it right at this moment in time. And I'm willing to take a small pop shot at it, but I'm as small a position as I trade ever. So that's something else that.
Well, plenty of reasons to give it a shot, Blake. You laid out a pretty good case for trying it anyway. You know, everything's a try, isn't it?
Yeah, I mean, but life is easier when you go with the direction of the trend. So, yeah. So
I don't know.
But
I've never made it easy on myself, buddy.
Yeah, but that's always going to be the easier trade. Going with the trend. And obviously the trend at this point in time, especially over the last week and a half or 2 weeks, is down. But also keep in mind, we've gone from 144 to 137, or a 700 pip move lower in 2 weeks. You know, does that mean that the pound is going to bounce? No, but you know, there's look, if we can get back above 137.50, I might hold on to it. If we can't get back above 137.50, I'm just gonna peel it off. And obviously, if it breaks through 137, I'm out. So
I think Stephen Grega would say the rapid descent and impulsive nature of this pound decline is kind of a hint that if you got like a 50% retracement, that the trend has shifted, because that was impulsive. I think, you know, I'm not an Elliotician, but the way when things happen in a hurry, it's usually impulsive.
Very, and so that means that it's the predominant new trend is going to be down. So I'm not a fan of going. I don't plan on staying around more than today. So, you know, but nothing goes straight up or straight down. It is the end of the month. You know, we could quite possibly see, you know, a 50, 60, 70 pip bounce today before it resumes. You know, you get that battering ram to go through this trend line. I think I think it actually breaks down. I just don't know if it's going to do it at this moment in time. And I sure as hell, if I was short the cable, I would be probably covering, or at least moving all my stops to protect my gains, because it is obviously extremely critical support at this point in time. So, you know, that's something that, you know, I'm thinking about. Also, you know, there's something else that's happening tonight that's really big, is that at midnight tonight, the tariffs expire for our partners, for our allies. So, you know, whether you're talking about the EU or Australia or you know, or you know, any other countries yeah, they all expire tonight at midnight. So
on the full moon, Blake.
I guess it is a full moon. I didn't know it was a full moon, but
all right.
but that's all pretty important, because I don't know what to expect, nor does anybody else. You know, what do we expect following midnight tonight? Does the U.S. impose tariffs on all of our quote unquote friendly countries that we normally do business with? Do we start imposing tariffs because they didn't negotiate well enough, or they didn't give us a good enough deal? And then if that happens, what's the retaliation from the EU specifically, or whoever else that we're doing business with? I think South Korea is exempted because of the negotiations that we've made, but what happens to everybody else, and how does that affect the currency market, and how does that affect risk in general? So there's a lot of question marks between today and tomorrow, and so that might create a little bit of volatility too. If you're long the dollar, but you see a lot of different countries fight back, does that impact the dollar at all? From a positive or negative standpoint, I don't know, but there's risk of more volatility just around the corner. So you have to be pretty careful here, especially if you've been long the dollar. But look, I'm bullish the dollar. I think I've told you in every week ahead video for the last few weeks, I've been looking to pick up dollars and buying dollars. It's been a tough trade getting this thing to, getting the dollar to turn here, but ultimately we found ourselves on the right side of the trade as the dollar is turned the corner. Now the question is, what type of follow through are we going to get here? And do you buy dollars right at this 200-day moving average? I mean, let's not forget this. Okay, it's early today. All right, this is the dollar index, and I'm going to stop here and talk about this chart for a second. Okay, and I know I talked about this on the week ahead video, so let's just stop here and talk about this for a moment. We are at the 200-day moving average on the dollar index, the 50% retracement of this last leg lower. You can see this last leg go lower, right? 50% retracement. 24% retracement from the highs to the lows, 24% retracement. Okay, now we're at the 200-day moving average, and also, if you guys don't see it, that is an ugly candle that we put in Friday. But look at right now. Look at right now. There's a big green candle, or white, or whatever color scheme your bullish candle is looking like, right? We have a big green candle following up yesterday's or Friday's reversal. But are we early or late into the session if you're a North American trader? We are very early in the session. Is it entirely possible that by the end of the day, isn't it entirely possible that this candle that currently is white, or blue or green, or however you look at it, is it possible that we end up with a red candle with another long wick? Something that looks like this by the end of the day. Is it another gravestone doji? It's possible, guys. Right now it's white. But we could reverse course here because it's the end of the month, and the dollar slumps by the end of the session. So don't get married to the idea that the dollar is going to break out today, because we had a major reversal candle on Friday, and the 200-day moving average is just above us, and you can see a bunch of confluence of support and resistance here. I wouldn't get married to the idea that the dollar is going higher at this moment. I think we have to see how the end of the day shakes out. And like I said, I'm willing to take a long in the cable, with very manageable risk. I was willing to take a small position, and I am still. I don't have any qualms with it, because I know if it breaks through 137, then it's all over. You know, then the pound is going a lot lower, and we're probably going to be above the 200-day moving average as a result in the dollar index. But yeah, it's the end of the month. Lot of potential volatility with all of these exclusions expiring at midnight, and we're at some key resistance. So, you know, obviously I have to be a little concerned. Also, and I don't want to take too much away from Steve and Stelios, but look at precious metals. You know, gold's approaching pretty critical support down here. So silver. And I guess I can ask Steve and Stelios right now. And I don't know if Stelios, I heard him earlier, but I think he's still in London. So, but I guess I can ask Steve to answer this, since I'm going to give him the screen here in a moment anyway. Steve, how do you feel about precious metals? And good morning, happy Monday, by the way.
Hey, Blake.
Hey, Steve.
Happy Monday.
Happy Monday to you.
I want to let you just let Stephen Aniston know that I see him and that his interview begins in 34 minutes. Welcome to Faith, Stephen.
Awesome. Welcome, Stephen. Have a great interview. So Steve Volgi. Vulgaris. Did I just mutilate your last
Don't
name?
worry about it.
Gosh,
Yeah.
I mean, we've been friends for years, and I can't spell you. I can't pronounce
It's
your last
okay. It's okay. I love you regardless.
name. All right.
Okay. What do I think about precious metals? I really have no opinion. I thought last week that you know, the fact that we are once again on the precipice of breakouts to the upside might actually do the trick this time. Once again, we didn't get that happening. We got rejected from major levels on almost all currencies, especially gold, copper. Got, you know, major rejections. But despite that, they remain in broader consolidations, and I don't think that this is enough for us to turn bearish. I think that we're once again back in you know, a very long-term consolidation in silver within the triangle in gold. Copper is not far away from important breakout area to the upside. So I think we need to remain patient.
Yeah, I think so too. And you know, we've gotten to the point in precious metals. I think if they're going to be supported, they're going to be supported somewhere around here, right? So
yeah. Quite
so
soon,
I mean, there's a good chance that they could bounce, and that's why I'm like, you know, I'm not 100% convinced that the dollar is ready to break above the 200-day moving average today. I think the dollar index is flirting with it. We had a big reversal from it on Friday. I would be a little nervous. You know, if I was long the dollar right now, I'd be a little careful.
I agree with you. Multiple confluence of multiple resistances between 91.60 and 92 in the DXY, and also indirectly you mentioned it before, saying that, listen, we're seeing this white candle in the DXY, but you know, nobody tells us that this cannot reverse by the end of the day. We need to remember that we've seen many times that the moves that start on a Sunday evening and might find follow through in the European session that follows on Monday, sometimes get completely reversed once the US market opens, right?
Right, exactly. And by the way, I just flipped you over the screen because I got to get back to trading. But yeah, that's exactly it. So anyway, I want to wish you guys a great Monday. I'm very excited, Dale, for all of your interviews this week, especially with Jim Rickards. He's a legend, and he's the author of Currency Wars. So it's going to be an awesome interview on Thursday, and if Stelios is here, still listening in, hope you have a safe travels home. And we have numbers that are being released right now. So
go get them, Blake.
All right, see you guys.
Go get them indeed.
Yeah, how are you, buddy?
I'm good, mate. I'm good.
Yeah. So getting closer to that stop hunt in gold under 1303.
Yeah, very close, very close. It depends actually of how you draw the line, but we've entered an area that you know, can easily act as support. I mean, anywhere between 1310 and let's say 1305. we know we should find support. Otherwise, we're going, as you mentioned, for a stop hand. Now, you asked before in your introduction, where is the triangle support in the silver? But as you see, if I zoom out, we have some distance from that, right? So depends on how soon we're going to get that there, because this is an ascending trend line. It's about $16 exactly. So as long as we remain above $16, there is nothing major that has happened here. We are within a very long-term consolidation. I mean, you can see that this ascending trend line goes all the way back to the end of 2015, and having to do with the descending line, it dates back to exactly a year ago. So this is a very long-term consolidation, and unless we break above it, I think that anything that happens in between this range, which is now just $1.50, is purely noise, right?
What would be your assumption if we broke down to the downside of the triangle? We closed under the blue line.
I'll tell you something in all honesty. Usually, when you get breakouts from such long-term major triangles, in this case, you should expect follow-through. But my personal bias is that, especially with what's happening, is that the precious metals should sooner or later see quite a lot of an upside. So my macro bias, let's say it, will prevent me from becoming a seller, even if we break to the downside, because I actually think that silver is cheap, and I think that if we go down to 15 and a half, 14 and a half, those are great long-term levels to be a buyer. So I'm looking to buy a breakout to the upside, but I'm not looking to sell a breakdown to the downside. But I will be monitoring it, because...
Okay, well, let me ask you this. So you have biases here. Cover up the title of silver, and there's no title. You don't know what instrument this is. You're just looking at the chart. If you were looking at this chart, what would you say are the possibilities if it breaks down? I'm not asking you, whether you would short it or buy it.
My bias would definitely be just looking at the chart for a strong follow through, even below the 13.5 low that we saw in 2000.
That was the gold slow, the flash crash. So maybe we have to eat into it at least.
Yeah, very likely.
That's what I'm thinking. Okay, thank you, buddy.
Very likely. My pleasure. So
I like grilling you once in a while. Keeps you on your toes.
It's my pleasure.
All right.
And having to do with copper, since we went into the precious metals, nothing much has changed with copper. This slow grind, lower is still resuming. For me, this horizontal area here, this descending trend line as well, remain of importance, because if we see a breakout from here, it's also the 61.8 of the last move lower. I think that the break will above 317, 318 will confirm that copper is resuming to the upside. So nothing has changed here for me as well. Now, having to do with the cable, I know that Blake mentioned it extensively, but I have to say here that, first of all, I confirm what he says. I see a 5-way move lower. I mean, it's quite clear here. You can very easily see it. 1, 2, 3, 4, 5, right? I'm expecting a rebound from here, where I would be looking for a resistance, in which case I'm going to be looking to be a seller. 139, you can see it was the low here of wave 4 in essence, and I would also be looking at the high of wave 4. You can also see that it was support here at 140. So 139 and 140, both of them round levels as well, as it happens in this occasion. I think good areas to be looking to short the cable. I was looking, if you remember, when we were consolidating here, I was hoping that this rebound, this fourth wave, would be stronger, that it would take us all the way up to 141 here. So I had an order to go short at 141, and unfortunately it never went there. So now I'm looking to sort of rebound to 139 and 140. How I'm going to handle this? Most probably I'm going to be selling half a position at 139, and if it makes it up on 140, I'm going to be adding, or alternatively, If it doesn't make it to 140 and I just get triggered on half a position, I'm going to be looking to add another half a position once the downtrend has reestablished itself and I have more confirmation. Okay, so I'm definitely looking to participate in this way for the cable. Also, I have to say that where is it? Let me show the gap. Here it is. So the gap, as we've seen, has finally broken below this ascending channel. It has also broken below this horizontal area. As you see, it acted as resistance, then it acted as support. Now we broke below it, and once again, it acted as resistance today. So you know, I should have probably sold half a position today earlier, but I didn't. I might, if we jump a little bit higher, I'm already half position short in the euro yen. If you remember from last week, I'm still holding this position, obviously. And you know, I'm looking here for a break below 131.60. I think that's going to be confirming that at least one more leg to the downside. I would be looking for 129 to be tested. At the very least, has resumed 50% fib. I think that we will then be headed for the 61.8. It was also this low here at 1936. I think that especially if we break below there, you know, the situation becomes quite a lot tougher, because the chances that this move lower is a corrective one will start decreasing substantially. Until that point, the chances are still valid. I mean, that this is still a corrective move before another high. So I remain, you know, a little bit more conservative having to do with the Euro USD. Now, let me say that for me, I also wrote it in the weekend analysis, the break below 76.40 in the Aussie USD was a major one. If I zoom out, you can see why, because in my opinion, this was just a long-term correction. And especially since we also closed the week below that, you know, that was a major development, of course, a major bearish development. And you know, the last area of support here is the 0.75 one. Especially if we break below there, we're even going to be registering on the longer term chart a lower low, which is going to be another confirmation that, you know, this has been you know, something major happening here, in which case I'm going to be reestablishing a long-term bearish bias for the Aussie. The Kiwi is not exactly there, but definitely the move lower has been a very impressive one. Might be on its way now to test the 61.8, almost confluences with the 161.8 extension of this rebound higher. Both of them come at, let's say, roughly 70 cents. So I think the 70 cents area, very critical area for the Kiwi. As well, as you can see, somebody can also see that this can easily be interpreted as a longer term correction to this bearish move that we've had, the one that started in the summer of 2014 and, you know, took more than a year to manifest. So I think that, you know, both of them are in the precipice of, you know, registering major bearish breaks. Now, having to do with risk and indices, since Blake didn't mention them, I'm still half a position long from 2,670 from Friday. I do think that, you know, we have no direction yet, no confirmed direction. But, you know, the longer we stay in this triangle, I think that the higher the chances of a break to the upside. So, you know, I took another shot to the upside. The previous time I got stopped out at break even. I don't have a problem, you know, doing the same here, getting stopped out of break even or at a small loss, because I think the chances of this breaking to the upside increase, as I said, by the day, as long as we don't break down. So you know, that's my personal intuition, but that doesn't change the fact that there is no confirmation yet, right? We see how important the 200 daily moving average has been. We haven't managed to decisively close below it. although we've tested it multiple times. On the other hand, we have this descending trend line. We still haven't tested it for a second time, after this one. So, I can say that, the more the days pass, it also coincides with the 61.8 of the last move lower, also this high. So definitely this, let's say, 27.15 area is quite an important area, because if we break above it, the chances of a bullish continuation increase substantially. So, if we do see a break above 27.15, I will feel much more comfortable with my long. I will actually be adding to it another half position, most likely than not. So, the other indices, don't present something different. They look a little bit different with each other, but you will still see consolidations. Here's the Nasdaq. The Dow Jones I wanted. Here's the Dow Jones, also finding support in the 200 DMA. I'm monitoring this descending trend line as well, but nothing really decisive. I definitely do believe that we should see a higher high here as well for me to feel more comfortable. But as I said, I'm going to be sticking with the S&P. On the other hand, the DAX. Personally, the DAX looks to me as bullish. I know that Greg is thinking that there's going to be continuation from here to the downside, and I respect his opinion very much. I mean, he's a great trader. Nevertheless, the consolidation that we've been seeing here for me looks more like a bullish consolidation that is likely to break above the 200 DMA and at least push once again towards the 61.8. This confluence actually of the 61.8 and this horizontal area of support resistance. You can see that this is the area we found a high during the summer of 2017. Then this is an area that was providing support for a long period of time. And why not act as resistance once again, right? So I do think that this consolidation has a very high chance of breaking the upside, in which case I'm going to be closely monitoring the 12,900 area, because only once we break above that as well, I'm going to be feeling very comfortable that the uptrend has resumed. Now the FTSE, on the other hand, being helped a lot by the devaluation of the pound, has been pushing higher in a V-shaped recovery. We've in essence appreciated, let's calculate it actually, we've appreciated to the high of today more than 10%, right? More than 10% within a little bit more than a calendar month. So it's a huge appreciation. It's a huge appreciation. Next and last area of resistance I have here is the 78.6 at 7,600 almost. It's also a horizontal area of resistance. You can see that we found a high there in the summer of 2017. We retested it. We found a high once again. So why not? It might act as resistance once more. But definitely after this kind of a move, even if we get rejected from there, I'm going to be looking for areas of support, because the FTSE looks better, especially given the fact that we've had this weakness in the pound. And as I said, I'm expecting a rebound to bring more weakness in the pound. So I would expect the FTSE to be one of the best performers to the upside. In essence, if I had to be buying one index on a pullback, that would definitely be the FTSE, based on the current structure and technical formation. A couple of more things, and then I'm going to go to questions. USD NOK is once again knocking the door of some confluence of resistances here. It's the 161.8% extension of this last corrective move. It's also the 50% fib of this move lower. It's as well a horizontal area of support resistance. You can see it here, but we got rejected on Friday from there. If we get rejected once again, fine. But if we do push higher, I'm going to be closely monitoring this 812 area. It's this parallel line to this one. It's also the 61.8. I want to be short USD NOK once again, but I don't think I'm ready to do that yet. So if we do get rejected once again from here, I might actually become short. I might actually take a position quite soon. if we do push higher, I'm going to be very, very closely monitoring this area, the 8-12 area. USD SEC also pushing higher once again. It got rejected from the 127.2 of this move lower, also a horizontal area of support resistance on Friday. It's pushing higher once again. I'm very eager to see if this area is actually going to reject the pair, more or less like USD NOK. If it does, fine. I think it's going to be enough to produce a correction to at least test back this breakout area of 850, 852. In which case, I would understand if somebody wouldn't want to try being long once again, or you want to be short from here for a counter trend move. You have a very well-defined risk, but I'm closely monitoring this area. I think it's a very important one, and USD Swiss, another one that is slicing through the 61.8, or at least is attempting to. If it does, I'm going to be monitoring at parity. I think that parity is also, a nice confluence of horizontal support, resistance area, and this ascending channel. It's definitely extremely overbought in the short term. I mean, we've had, what was it, like 10 consecutive days to the upside. Friday's rejection was just, one day, and we seem to be pushing higher once again. I do think that at some point, it needs to move, to at least correct this move lower. If we do push to parity, I will be looking for this confluence of resistances to act as support. So I will be looking for 98.50 as a buying opportunity. Until then, I think buying up here it makes no sense, right? Makes no sense. You have nowhere to place your stop. There is no reward to risk ratio in any case. So let's have a look at a few questions and we take it from there. Let me see. CAD yen, absolutely. And it's a good opportunity because I think we haven't spoken much about this pair, or I might have mentioned it on Friday. What I've seen CAD yen is possibly a triangle. That tells me that a resumption to the upside for at least one more leg is likely, because this looks very much like a triangle. We came from a move from the downside, so even as a corrective move, why not see one more push to the upside? We have a nice confluence of resistances at 87.35. It's the 200 DMA. It's also the 61.8. So this is what I'm seeing here as a likelihood: one more push to the upside and then a resumption to the downside. Obviously, if we see a break below 84.30, probably we invalidate this view. Okay, until then, I like this scenario. I like it a lot. Yes, we do take questions because we had somebody asking here. Let's have at the euro pound. We had a question about the euro pound. Okay, euro pound actually produced some follow through today initially towards the 61.8, but we're seeing an attempt for a key reversal so far. I have to tell you that I'm not trusting euro pound in any way, right? I mean, I know that a lot of people were monitoring this 88 area since it was an area of support here, resistance there. Let me mark it also. An area of support here, resistance here, resistance here. Also, a lot of people were saying this is an inverted head and shoulders formation, although I don't like it so much because we don't see much symmetry between this shoulder and this one. But still, I have to tell you that I don't trust this move, and I wouldn't be playing the inverted head and shoulders formation simply because this is a very well-defined range. It's not exactly a range, it's a slightly descending channel, which has been in effect since September of last year, right? So I, in all honesty, have no intention of being short or long while we're in the middle of it, because this range has been active since September. Nobody tells me that it cannot resume producing like choppy price action within it for another 2 months, 3 months, or whatever. So before I get interested to being involved with this pair once again, I would really want to see some kind of a breakout, some kind of a confirmation that we're done trading within this range. As I've said plenty of times, my personal bias has me preferring a break to the downside for a move towards the 083 area. Okay, but that doesn't mean I'm going to be trading it in advance. Okay, we have a question about USD ZAR, but this is a good opportunity for me to show that commodity and exotic currencies have been in important points, many of them. USD ruble is resuming to the upside. I'm still holding half a position long here. I'm comfortably in the money, almost 3% in the money. I think that we can easily see a push above the 65 area, that we got the Russian Central Bank intervening, or at least another retest of the 65 area, in which case I'm going to be probably offloading my position. But if you look at some more of the exotic currencies, you're going to see that, for example, USD, Chinese yuan, you can see that we are testing this channel's resistance. If we do break above it, I think that we will finally, after a very long time, see some kind of a deeper pullback, some kind of a correction that should take us at least to 66.45. Okay, so that's what I would be expecting if we do see a confirmed close above there. Also, USD with the Singaporean dollar, it seems to have broken above its channel. It seems to be consolidating now. For me to confirm, I would want to see an acceleration now, right? So this is the point in time in which this is required to produce some follow through for me to trust this breakout. And also USD ZAR, since you're asking about it, we broke above this inverted head and shoulders formation. We also broke above this horizontal area of support resistance. The recent price action looks to me more like a consolidation, in which case I don't expect this to roll over and resume to the downside yet. I would most probably see, as you see, I drew it there, another, at least one more leg to the upside, perhaps towards this low there, 1275, or even a little bit higher, towards quite a bit higher, actually, towards the 1312 zone once again. So I do think that the rebound for the USD ZAR is not done yet, and I do think that for me to believe that the downside is resuming, I would want to see a break below 1218. Then and only then I would be feeling comfortable that the downtrend is resuming. But let me make it clear here that I am viewing these moves as corrective ones. In all the pairs that I showed, I'm viewing those moves as corrective and not new impulses to the upside. Okay, so take that into account, having to do with what you want to do with this. Now, having to do with crude, because we have another question about it, I do believe that as long as we're consolidating above this breakout level, another push to the upside towards the 72 area is likely. Not necessarily required, but likely. So I wouldn't be shorting yet. Okay, I would really love to see one more push to the upside and the rejection from there. I would be very interested to be short, in that occasion.
Probably get that shot if they decertify the Iranian nuclear deal.
Yes.
And that's only, I think it's only a week or so away for that decision.
We'll find out, but the first indications, at least from the statements that we've seen so far, show that Trump wants to do that, right, Dale?
Yeah. Yeah, and yesterday there was an Israeli strike in Syria, killed a lot of Iranian soldiers. It's heating up, buddy.
Yeah, it seems to be going that way. So it is a likely scenario. It is a likely scenario, and that can actually end up being buy the rumor, sell the news. We might see a bounce if that happens initially, and then when everybody's going to be like, okay, another leg to the upside is beginning, especially now that we also have a macro reason to base this fact. And how many times have you seen that happen in the markets, Dale? And then suddenly, when everybody gets very comfortable with being bullish, the market initially, without any reason, or at least seemingly without any macro reason, rolls over and everybody finds themselves being completely wrongly positioned, right? How many times have we seen that?
Quite a few times. Also, we've seen quite a few times that the U.S. is willing to go to war over hegemony, and the Iranians are not accepting oil payments in dollars. Okay, so that's what happened with Saddam. So not using the petrodollar, actually, you know, that you could point to examples that neocons think, you know, that's really an act of war in the U.S. because it's happened before for the same reason. Seems like a silly reason, but it's almost like trying to preserve the petrocurrency.
Yeah. Let's not forget that Gaddafi did the same, right? He started not accepting dollars for oil. But
he wanted dinars. He wanted dinars, and they took him out.
Yeah.
All I know is, please don't pay me in euros. All right, guys.
So
lost. Yeah.
Yeah, he's doing it again, Steve.
We're being hacked by the NSA. So,
probably 2 more pairs, and then you can start your interview. Hear me again.
Okay. You faded again for that 20-second period.
Now
we can hear you.
Okay. Yeah. Okay, perfect. So 2 more things I want to show, and then you can go ahead with your interview. One of them is the Kiwi yen, and the other one the Aussie yen. Kiwi yen, a very, very nice rejection from the confluence of the 200 DMA and the 61.8, also horizontal area of support resistance. It's currently testing the 61.8. I think that the resumption to the downside is likely, and especially if we break below the 76 area, I think that there is a lot more downside. So I think this can prove to be a major development, but we still have some way to move. And you know, the Aussie yen, I'm monitoring this ascending channel because you know it's very likely it's a corrective one. If we do get a rebound from here, we might see one more leg to the upside and then resuming to the downside. But if we do break down from here, I think that you know this is going to be an indication that the correction high is over, and you know the downtrend is reestablishing itself. So I think you said your guest is here, Dale, right?
Yep.
Okay. So enjoy the interview, and we will be here again tomorrow as always.
Thank you very much, Steve, Stell, Blake. Welcome to Faith, Stephen Aniston. I'm making you the presenter. Looking forward to meeting you. And everyone will learn that VIX is not a cough drop, although you can joke trading it.
Okay. Can you hear me now?
Yeah, I hear you loud and clear, Stephen, aka Stevie VIX. How are you today?
Good. Glad to be on here with you guys. You know, very nice presentations. Appreciate it here.
Thank you very much. Very nice to meet you too, and timely topic. So, I went to your website, read a little bit about it. So, the beginning of your journey was as an IT guy. Is that correct, Stephen?
That's right. Yeah, I was a technology manager at big banks for for about 15 years. Yeah, I worked at Bank of New York, Royal Bank of Scotland, Goldman Sachs. Yeah, so I kind of did a tour over there.
Did you get the trading bug there while you were doing IT?
Yeah, ironically, I got the trading. Yeah, at Goldman, I was kind of in the merchant banking division. It was mostly private equity, so doing a lot of valuation stuff. But really, I got the trading bug in RBS because I was working with the institutional research people. So they were sending out these, a lot of research for, gold prices and S&P 500, and that's where I actually got the bug.
Well, that was a good place to get the bug because they had some probably very competent technicians, fundamentalists, or they wouldn't be on the payroll. So, I know a lot of people like to fade banks, but, banks don't pay people 6 figures as analysts, and I don't know if they even do anymore, but unless they, have a proven history of being able to see the market. So did you gravitate more towards technicals or fundamentals? Who was a big influence on you in your trading life?
Well, I kind of look at everything. I don't have an approach of like one or the other. I just go with everything, So everything is meaningful information. Everything is used by somebody, and everything matters. So that's my view of it.
All right. So also read you started this website out, VIX Contango, as a hobby, and there was just so much demand for it. You turned it into a professional website. So really, the key thing to address is, I know selling volatility, because there's a lot of decay in the instruments, Stephen, is a bit similar to people who write options, correct?
That's right. Yeah.
Okay, so you have the decay happening in these instruments just like you do on puts and calls. And it's like picking up quarters on the sidewalk until a steamroller comes down the street. And I would say that what happened in February was definitely a steamroller. Were you able to get out of the way of a short vol strategy before that spike to 50? Did you see it coming? How do you manage risk, even though it only seems to happen every few years?
Yeah, I mean, we, basically, I'm right now I'm a VIX-based, investment manager. So I'm an investment manager who pretty much invests in volatility instruments only. And while over the last couple of years, selling volatility has been the right trade and a good trade. I'm not necessarily a one-trick pony, so to speak. We don't view the market as just having a single direction. A lot of people basically like to sell volatility because it's the same trade as being long the stock market. But it's kind of a leveraged play on being long the stock market, so you make more money, right? So
yeah, a lot of people got blown out of the water, and even a few instruments ended up not functioning well. So,
go ahead. Yeah. But that's not my view. I'm kind of a basically long short, so I would play long volatility as well as short volatility.
I see.
Depending on how I read the situation.
Okay. How did you navigate it when it happened? Were you surprised at 50? I mean, 50 happened the last time was with a yuan devaluation. I think it was 2015?
Yeah, I mean, no, we've been, we were short volatility for the last couple of years, but basically right around when they passed the tax cuts, we went long volatility. So we've been on the side of long volatility since then. So I just, I think that's going to be the right trade for the next couple of years, and I don't think short volatility is going to pay. I mean, we already saw how everybody lost their money, and that's going to continue for a few more years.
To me, it looks like, up until, except for a few exceptions, the VIX chart looks like an EKG of someone in a coma, that every once in a while it gets electric shock treatment. And I'm curious if you think, since a lot of people can call this an asset class, or do call it an asset class, whether or not we could get trends in the VIX instead of dormancy and then spikes, and then dormancy and then spikes. Do you think the regime has changed? We're putting in higher lows even though we're under 20, that that was kind of like the volcano woke up, and even though we're not spewing lava right now, that this is the beginning of an uptrend in volatility, and it could be more of a technical trading market instead of just doing nothing and then doing something spectacular?
Yeah, well, it was, I would say this was kind of the tremor before the earthquake. So, our basically thesis for this year is that we're going to see volatility normalization. So in 2017, we saw extremely low levels of volatility, right? I mean, record levels of volatility never seen before.
Right.
VIX being below 10, in single digits for 40, 50 days. whereas before that, the total number of such days was like 4 or something like that. So this year we think that volatility is going to normalize, and the normal average of the VIX is about 19, but we think this is also a structural change in a volatility regime that's going to continue to go up, to go higher after that as well.
Why? Because of the contango? Just guessing.
Well, the reason for that are basically fundamental. So I do a lot of fundamental analysis on my website. So we look at corporate earnings, corporate earnings growth, and valuation levels. I mean, I have a model kind of how to predict volatility, right? It's I call it an EVIL model, EVIL.
Okay.
And it's each one of them stands for E is for earnings growth, V is for valuation, I is for implied correlations, and L is for liquidity. So just to so first we look at earnings growth, right? Is earnings growth there or not, right? That determines then valuation. So then you look at valuations. Do the valuations make sense compared to the earnings growth that is projected? Right? Sometimes valuations can be above it, sometimes below it, right? So there's different opportunities. Then you look at implied correlation. So you look at inside of the sectors and see which sectors are overvalued and how big they are, right? Is there a lot of skew in there? Because basically, if your biggest sectors are overvalued, right? And then people need to sell them, and there's no place basically to put the money, then volatility has to rise. People have to hedge, okay? And the movement of the index becomes bigger. And finally, we look at liquidity conditions. There's money coming in and out of it. So, can I share the screen? Maybe I can kind of go over some of these things and kind of explain.
Sure. We're looking at your screen.
Oh, you're looking at my screen. So,
yeah.
So are you seeing the VIX Contango website now? Or
yes, correct.
What you see? Okay. So yeah, I mean, I think you have questions that you want to ask me. Just keep asking me, then maybe I can go into that part later on. I had some charts that I created.
Yeah, go ahead. Show us what you got, buddy. Appreciate you thinking about things you wanted to talk about. It's foreign to most people. Even though I trade it, I don't know everything about it. So you're the VIX expert in here right now. Why don't you give us a little tutorial on things you look at?
Sure. So, ultimately the VIX is the sexy part, but to get to there, right, you need to base it on something, right?
Right.
So the first thing, we kind of look at, for example, is the earnings growth. I mean, you hear that on TV all the time. It's a legitimate thing to listen to. But basically, if you look at this year, earnings have got, earnings normally go down throughout the year, but this year, because of the tax cut, right, things have kind of changed. Earnings this late into the game for 2018 have actually gone up a lot, right? So right now they're still at 154, right, for next year. So, in a lot of ways, this is as good as it gets because I expect this thing to go down like this, Okay,
so the tax package made it front loaded, and it's aberrational what's happening right now because of it.
That's right. But the thing you got to understand is what the market looks at is it looks at next year. So it looks at the 2019 earnings and then the earnings growth. So it looks at that difference here between this and this, right? And well, for example, for the previous year, right? If you look at 2018 and 2017, right? 2017 is 109, right? And you get to 154. I mean, this is a huge bump, right? That's why the market went up last year, because it's looking at this huge, this huge difference. Like, okay, we got to front run that, right? And so they front ran it, but you see now the market is not accelerating, even though people are giving you good earnings. Why? Because the market is looking at next year. So it's looking at this difference here, and this difference, this year is setting up a very high watermark, and this difference is very small. It's about 10%, right?
You sound like the Caterpillar guy. Wasn't it the Caterpillar guy said we reach a high watermark? And
That's
the market sold off. Yeah. Okay.
Yeah.
Go ahead.
So you look at the growth rate, right? It's in 2018 is great, but you look at next year, it's starting to become single digits, 10%. And this is usually, it comes down from that as time goes by. So the market you're looking at right now is basically, looking at 10 years 10% earnings next year. And so then what is the right multiple for that, right? So then you go to the question is, what is the right multiple for this type of earning growth? So if you look at the multiples based on whether on a trailing or a forward basic, they're very expensive. I mean, you look at 2016, this is a chart that goes back 3 years, but, we're basically in the 20s, right? On a gap or non-gap basis, we're 20 multiples. So 20 multiple usually goes with earnings growth of about 17, 18%, right? So it makes sense for where we were last year. Does it make sense for next year, right? If you go to earnings growth of 10%, you normally look at multiples of 12, okay? So you're no longer talking about multiples of 20, you're talking about multiples of 12, 13, and 14, which is, by the way, I actually want to go back a couple of years. If you look at here,
it was kind of the norm, right?
Yeah, this is the norm. This is, you look at this number here, 147. This is actually the first time we had premiered earnings of about 150. This was for 2015 year, okay? So this is in 2014, we had this. And do you remember what the S&P 500 traded in 2014? 1,800, right? It was 1,800. Right. So the multiple was 12.
You didn't give me a chance.
Huh?
You didn't give me a chance to answer, buddy.
Sorry.
All right. You're like my college professors.
Right.
A college professor once asked me this, Stephen. What's worse, ignorance or apathy? And I said, I don't know, and I don't care.
I would have answered arrogance.
All right. So let me ask you this. So, do you take into consideration yields moving up from where we were before to, the 10-year trading at 3 into your model at all? Does it play in?
Yeah. So the yields, the market basically right now has a greater fool problem. So everybody's out there trying to pitch you this great story, and obviously what they're finding out is people are selling into it. And the reason why people are selling into it is because yields are going up, and particularly, if you look at the yields, the thing to understand, I don't know if people understand that, basically long-term yields are kind of a function of the growth of the economy, right? So they kind of more correlate to GDP growth and nominal GDP growth, right? So that's why they kind of been very difficult to rise. The 10-year yield, it's still 3% or so. I mean, it should be 4 or 5, if you had a good economy. But the front end of the curve, the 2-year yield, the 1-year yield, the 6-month yield is basically very responsive to inflation, right? So inflation has been picking up. I mean, if you look at the inflation indicators, they're all above 2%, and they're going to go to 2.5% to 3% over the next 6 months. So yields have risen a lot on the short curve. So if you're an investor right now and you look at, like you can buy a 1-month treasury, it gives you 2% on a year, right? I mean, and it's going to be 3%, within 6 to 9 months.
Which is pretty good compared to 0.5.
Yeah, it's fantastic, and it's better than the S&P 500 yields. And you're looking at stocks which are overvalued. So you have all
the competition. Good. So even at these low levels, because valuations are so stretched with the charts that you've showed us, that even a move to 2% yields is competition for stocks.
It's competition for stocks, yeah, and that's why the chart that I have on the screen right now is showing how the S&P 500, the SPY fund flows have been basically negative all year. As these yields rise, as these short-term yields rise, basically people are just going to Treasury Direct and stuffing their money in. That's what I'm doing. So that's what I'm trying to say. The market, has a greater fool problem. Like if you buy the stocks here now, you need to find a greater fool to sell them at a higher multiple. And so who's going to be that guy? I've talked to a lot of investors. I have client accounts. I mean, everybody's basically You know, I've been through 2000. I've been through 2007. You know, I don't want to repeat the same mistake again, right?
Right. So does that, the fact that people are worried about it, could that almost be a bit of a contrarian indicator that the market has legs because, you know, sometimes it takes time to turn a battleship around?
Well, so speaking of basically the multiples, right? I mean, if you look at $170 earnings for 2019 and you assign a 12 to 14 multiple, which is where it should be, right? The S&P 500 should be in a 2,000 to between 2,000 and 2,400, right?
Okay.
I mean, we're way above that, right? So,
okay.
So you got to ask yourself, right? I mean, you've had like 4 months this year. You know, why are we not at 2,800? Why are we still at 2,650? Right?
Right.
You've had 4 months. You know, you had the shock drop, you had the recovery. Now the question is, why aren't you higher? Right? It's been 4 months.
Why, you know, the bulls could say, why haven't you taken out that Fed low? What's taking you so long?
Well, I mean, you know, generally you know, well, first of all, we're through the first half of the year, which is the best part, and you have a lot of flows.
So you think we might have a sell in May and go away? Might be happening this year.
I mean, it hasn't happened the last 5 years, but at some point, you know, we're going to have a negative May, right?
Mm-hmm.
I mean, it's
May. Except for my birthday on the 27th, it could be a negative May. So, Stephen, how are you playing it then? If you're long vol, what are the best instruments for retail traders? Because I'll tell you the truth. I bought TVIX before, and that has one of the biggest decays. Are there VIX instruments that don't have as much decay that people could be long vol with? How does a average trader get long vol? What are your preferred ways to do it? With options, with ETFs?
No, I trade ETFs. I trade the TVIX. I trade the VXX. I trade X.
Do they all have the same decay rate? Do they, or do some have less decay?
Well, TVIX is a leverage instrument, right? So whatever the decay is, it's double that. So that can lose money very quickly. Right. Now the thing you got to understand is for the VIX trade, right, is basically we look at the spread, basically you look at the decay, right? So the decay is the contango or the royo, right? So right now it's a little bit kind of about 2%, but for the entirety of the year, right, we have had a very flat curve, right? I mean, contango is basically 0%. The royo, the average for the year is 0%, right? So it is let me just show a report here. So
and wasn't there a case, Stephen, where the front month was trading at a premium where there was backwardation?
That's right.
The spike. So there were a few tells, and the one tell I noticed was during the final week or two of the S&P blowing off towards 2,800, the VIX wasn't making new lows. It was putting in a higher low above 10. We weren't in the 9s anymore. We're trading 10.5. But also you could look at backwardation as being a signal. Are we in backwardation now?
So we were on Thursday. Then that thing moves up and down a lot. But basically, we have been in backwardation for majority of the year, right? This is kind of what I'm trying to show you. Look at the contango, which is basically whether you're contango or backwardation. It's on average negative this year, right? So you look at all these years, you have 9%, 8%, 4%, right? This year we're flat, right? We're basically we're the same level as 2008. So what I'm trying to say is yes, there is a decay normally, right? We've seen in prior years, but this year there is no decay, so you don't have to pay money to hold VIX because the curve is flat. So if TVIX and VIX have fluctuations this year is because they fluctuate together with the VIX, right? The VIX itself moves up and down, but there's no structural decay this year.
Okay, so this is the best time to own these instruments since 2008.
That's right. I mean, basically the market is telling you need to be long VIX here because it doesn't cost you any money to be long VIX.
Yeah, okay. What a great point. You know, so I did my TVIX trades without this knowledge, and they melted away. So it's interesting that that 2008 is the last year. Do you have any stats for 2000? Was it like that before the .com bubble?
Well, the stats for the VIX futures market go down to 2000.
Oh, yeah, that's right. It wasn't. They weren't around yet.
Yeah.
Okay.
But no, if you look at the .com bubble, you know, you likely would have seen, you know, a very flat curve because the VIX was very high at the time. I mean, the VIX for 6 years was like at 25, you know, average 25,
Okay.
26.
What a great presentation. I learned quite a lot from you today, Stephen. I really appreciate it.
Yeah, I mean,
anything you wanted to wrap it up with?
Yeah, I just wanted to say, if you know, when you look at volatility, a lot of people just look at the VIX, you know, and in this thing, you know, you need to look at more than just the VIX. You need to look at the VIX futures market, the spreads there. You need to look at the VVIX, you know, how volatility is moving around. You need to look at the VRP, volatility risk premium. This is actually the one last thing I wanted to kind of finish up the presentation with.
Go ahead.
The volatility risk premium. So this is the difference between the VIX and the realized level of volatility in S&P 500, right? So this is how most people trade it, right? And generally the VIX trades at a premium to realized volatility, so about 30% above, right? So if you look at this chart here, right, the VIX has been very, you know, it's very bizarre. So the S&P 500 has moved a lot. You know, we had big February and March moving up and down, but the VIX has been very suppressed, you know. Like if you look at this chart, the VIX basically over the past 60 days has been going down nonstop. You know, it's basically 2/3 of the time has been going down. So what we have here is a year where the VIX is actually below realized volatility levels, right? It's a very bizarre outlier year, right? You see, normally it's around here, right?
Yeah.
This number should be here.
They're giving them away. No one wants them.
They're giving them away, exactly.
Because people that have tried it to be long these instruments for the last few years have lost most of their money. So they don't even want to try it anymore. And I also heard from a lot of people before we had the break in February that people got tired of buying puts or any kind of volatility protection. They said it was a waste of money until it happened. You know what I mean? They gave up. They're going, well, why am I buying insurance? You know, I've never needed it. And then they, you know, without it, they had February. So,
well,
I tell you what.
If you talked to me last year, I would have told you, like, why are you going to be buying insurance ahead of a 20-25% earnings growth, right?
Yeah. All right. Well, that brings me to a great point for people that are interested in trading and learning about the VIX. Why don't you put your website back up there and show people where they could reach you at VIXcontango.com. They could find you on Twitter at VIXcontango.
That's right.
And you have a subscription for to serve the self-directed trader, not just institutions.
Yeah, you know, most of our clients are, you know, retail traders. You know, I have a few financial advisors, but it's mostly retail investors. Yeah. Okay.
And do you have any type of trial, or what's the rate per month to?
Yeah, so we're you know, we're about we do quarterly or annually, so it's about you know, $1,200 per year, so you know, roughly about $100 per month. You know, that's what we recommend to people. You know, we have you know, we issue alerts. We have a few algorithms that issue alerts. I also issue discretionary trade alerts. You know, what I think people should do. You know, not just technical based alerts, and we have a lot of reports and a lot of you know, kind of dashboards to follow these indicators that I just mentioned. You know, so we track about 20 volatility indicators along with fundamental data. You know, in a way that generally is not available out there, and that's generally what people sign up for.
Okay, well,
you know,
Go ahead.
Our returns trading the VIX have been, around 50% over the past 3 years per year. So
wow.
This is an instrument that moves a lot. We're not perfectly capturing the moves, but something moves like 100 to 200%. We're usually on the trend. We're on the right side of the trade, and we capture about half of that.
Well, thank you so much for coming in and edifying the FACE community and me about VIX and showing some real key charts that I, never considered before. Really appreciate this, Stephen. I'm glad I reached out to you, and perhaps we could do this again down the road. And you're now my trading warrior brother. So thank you very much, Stephen.
Sounds good. Thank you for having me.
All right. Everyone, that's Stephen Anderson. You can follow him at VIX Contango. Go to his website to learn about the VIX. See everyone tomorrow for Turnaround Tuesday. Remember, don't just count your pips, whether it's in VIX or currency or anything else. Count your blessings. See everyone tomorrow. Adios. Thank you, Stephen.
Bye.